Now that we understand the different bodies involved with oversight and creation of accounting rules, we're going to look at some of the generally accepted accounting principles that provide guidelines when the Financial Accounting Standards Board create accounting rules. Okay, so we are going to look at, as your book calls it, some of the principles, assumptions, and concepts. That guide developments of those generally accepted accounting principles. Okay. I like to think of these core principles and concepts as if we were building a house. Okay, so I call it the house of GAAP. Of course, a house has a foundation on which everything is built, right? We'll get to that in a second. And then they have some building blocks. I think I'm going to need a bigger house. Okay. All right, so these are some general principles, assumptions, and concepts that guide the Financial Accounting Standards Board, that body, that private board that guides them as they are creating those 25,000 pages of rules, right? We want to make sure those rules meet all the objectives, but also adhere to these principles that we are going to cover here. All right, so one of the first ones, see, I'll mostly go in the order of your book. Let's start with the cost principle. Okay, the cost principle provides us guidance when we're trying to record financial transactions for a company. Let's say they purchase some assets. Okay, maybe we purchase a building and the price tag is $100,000, but it was advertised for $95,000. But then maybe an appraiser comes by and says, oh no, it's actually worth $110,000. As the accountant, you might be wondering, which amount should I use? So you go back to this framework, or GAAP does, and they look at and they say, you know what? We should record all assets at cost, meaning the amount we paid. So the cost principle tells a company to record assets at the amount paid. The amounts paid. Okay, it's just less subjective that way, and we want to strive for there to be a objectivity in our numbers, right? That it's not just subject to one appraiser's opinion, right? We want it to be objective, and that would be what the market bears for the price. All right, so that's the cost principle. And again, we're learning the basics here. You'll learn more intricate rules later on. All right, then we have the full disclosure principle. Okay, the full disclosure principle states that all relevant information be presented. Okay, and this could be a financial disclosure or even a non-financial disclosure. If it's relevant information, it should be passed on to the public, right? So if the company is in jeopardy of going into bankruptcy, that is a really relevant information to the public, and it should be disclosed in their financial statements. Okay, so that's the full disclosure principle. The next principle we'll look at is the separate entity concept. Separate entity concept. Also sometimes called the business entity concept. Okay. The separate entity concept tells us that we must account for a business separately from the owner's activities. So we must account for business operations separately from its owners. Owner or owners. Okay, so you have an owner and they own a business. And it's saying that you shouldn't put the owner's assets. Maybe they have a vehicle, right? You're not going to put the vehicle as one of the assets for the company. We have to keep the owner's assets separate from the company's assets. That way we can get a true picture of the company's financial well-being without commingling the assets, right? So that's what the separate entity concept tells us. All right, next we have monetary measurement principle. Or concept. A lot of these terms you'll hear interchangeably: concept, principle, assumption. Just think of them as guidelines. Okay, so the monetary measurement principle says that when we're recording events, that we should record them in some unit of measurement, right? Record transactions with some common unit of measurement, common units of measurement. And we've decided that here in the United States, that should be the US dollar. Okay. So if we're a company, on our financial statement, we're not going to say our inventory consists of 50 boxes of merchandise. No, we need to quantify that. We need to put it into US dollars. What US dollar? The amount that we paid. Okay, amount we paid for that inventory. One other thing I'll add to the monetary measurement principle, sometimes it's called the stable monetary measurement principle, because it also says, kind of the second part to it, is that we should not change the US dollar amount. So it does not change for inflation or deflation. Okay, doesn't change. So it's stable over time. All right. The next four, we have the time period assumption or principle. Okay, so this says that that a company can report financial events in shorter artificial time periods. Because that goes back to that objective of timeliness. We want to have timely information available to our investors, right? So we know that a company hopes to be around for a long time, right? You look at Ford Motor Company, they've been around for over 100 years, right? So they hope to be around for a long time, 100 plus years. And they might make the argument, well, gosh, I don't know what my financial condition is until the end of my 100th year, until I'm completely done. Then I'll know how successful I was. But obviously investors can't wait that long. So we say, yeah, we know that's the case, but we need you to provide reporting in a shorter time period than that. And generally it's agreed that that is a 1 year increment. Okay, so we're assuming that we can take the long life of the company and chop it up into these smaller artificial time periods, which we agree on as being a year. So that's the time period principle. Next, we have the going concern assumption. Okay. Going concern assumption means that we assume, okay, when we present financial information, it's with the assumption that a company will continue to operate for the foreseeable future. Okay, and that's because it impacts how we report things. If there is a concern that they are not going to be operating in the near future, like their business is in jeopardy of going under for any reason, then it's going to change how we state information. We're obviously going to have a lot of disclosures, but we're also probably going to report our financial information at liquidation prices. And so we avoid doing that by just saying, well, we're assuming that all companies have the honest intent of pursuing a, worthwhile and honest business venture. They're not a scam company or anything like that. All right, and now we're left with our last two, which are arguably the most important and sometimes difficult for students. So we have the revenue recognition principle and the expense recognition principle. Okay, together, these two make the basis for accrual accounting. Accrual-based accounting. There's two types of accounting, two ways for a company to report their financial items. One's accrual basis accounting and the other is cash basis accounting. If you're a big public company, you can't use cash basis as a rule. You are required to use accrual basis accounting. Okay, and the two core principles that really make up that methodology is your revenue and your expense recognition principles. And the reason I say it's hard for students is because as individuals, we're all cash basis, right? We don't call something a revenue until we have the cash in hand or an expense until we pay the cash out. But here, the revenue recognition principle provides guidance when a company can record revenue. So when can a company record revenue? So a company can record revenue when it is earned, Okay, if you've taken business law, they usually call this satisfying the performance obligation. It basically means that we have done the work that we were hired to do. Okay, we got off of our bottoms, we did the work, and we are now legally entitled to receive payment. Okay, same thing with expense recognition. When does a company call something an expense? When do they book it or record it as an expense? It says that a company should record, shall record expenses in the same time period in which they receive the benefit. In which benefit is received. Okay, so that means if we get a utility bill for December, okay, but we're not going to pay it until January. I get my PG&E bill for December's electricity and I say, yeah, I'll pay it in January. It's not due till January 10th. If I was cash basis, the expense would be recorded in January. But we're going with accrual basis in this class. That's the default. So accrual basis follow these two principles, which says I have to record the expense when I got the benefit. I got electricity in December, so I have to record the expense of those utilities in December. Okay. Don't worry, we'll practice more with those two in the weeks to come. All right, and then you have three, they're called constraints. Okay, materiality, conservatism, and cost benefit. Basically, and this is our foundation of the house, right? And so this says that if any item is immaterial or would result in an approach that is not conservative or the costs exceed the benefits, if that happens, then we can waive any of these rules. Okay, so for example, if we have some information, but it's immaterial, so materiality means it's significant in monetary value, significant dollar value. But if we have something and it's immaterial, it's a very, very small amount, maybe $100 for a multi-million-dollar company, that's a small amount. So if we have $100 item and we're like, gosh, should we disclose it? Because it's immaterial, we don't have to disclose it, okay? So we're able to kind of disregard some of those previous guidelines. Conservatism says that we should always choose the option that is least likely to overstate assets, least likely to overstate assets or net income. Right, we're trying to breed trust here. And so if we're overstating assets or net income, and we have another option that allows us to be more conservative, we should take that approach, okay? Err on the side of caution, basically. And then cost benefit is what it sounds like. The cost of being in compliance with the accounting rules should not exceed the benefits. We don't want to drive companies out of business just because we're saying, hey, these are some rules in the profession you should follow. It doesn't mean they need to go out and buy the most expensive accounting system or hire 100 people for their accounting department. The costs have to be in line with the benefits. All right, there's your definitions. Feel free to read through them more in your book, but I think I gave you pretty good definitions there. So you can try some of the exercises that are posted.